Right, let's see if we can tell you a little story. Imagine if you were broke, stony broke, at home, feeling sorry for yourself. Actually, if you're watching this show, you probably are. You got no money in the bank, no money under the mattress. As a last resort, you look in your sock. That's empty too. What would you do? You've already tried a bailout, or two, or three, and then by chance you look in the shed in the bottom of the garden and you find a printing press. And you think, hello, I'll print myself some money. You getting this story? I digress, but only a little bit. Here's Giles with his guide to quantitative easing. It's not a laxative. It's because with interest rates so low, the Bank of England is running out of ways to kickstart the economy. So today they decided to go ahead and magic up tens and billions of pounds out of thin air.
Put simply, quantitative easing is a tool for fixing a blockage in an economy that isn't running smoothly. But how does it work? Well, first, it relies on the government allowing the one mechanic who's able to utilise this tool, a central bank, to do a little bit of conjuring. Now, in our case, that bank is the Bank of England, and it effectively takes this tool of monetary policy and simply increases its bank balance, just like that, by an amount the Chancellor will set. It's like creating money out of thin air or filling up a petrol tank with imaginary petrol. Then, the theory is that you take that money and feed it back into the system in very specific ways, so that eventually you ease things up and you start fixing the ailing engines of the economy. So what are these specialist ways? Well, there's three specific ones. They can buy government bonds. These are the government's IOUs to people who've lent them money to be paid back over a specified amount of time with interest. Or they can just loan to other banks. Or they can buy other banks' assets for currency. Or most likely of all, a very specialist mix of all three. Now, the aim is to reduce the interest payback on government bonds, reduce the overnight interbank lending rate, and increase the amount of deposits in private banks. The effect should be to increase the supply of money in the system and thereby get lending going again between the banks. That is what most economists agree is needed to get any recovery started.
Giles still not there.